understand, then we will do, then I will explain you how you can do the valuation, how you can yourself do the valuation rather than you are engaging somebody else to do the valuation. At least a little bit of information, like at least a preliminary information, if you have, you can do the valuation at your own. And then at last we will see some case studies, the valuation reports of 2-3 startups. So we will see that how their valuation has been arrived, what kind of assumptions they have taken. So this is how the whole thing will be, we will be running this accordingly. So now at the same time we will have some question answer round also at the last, but at the same time we will have the Q&A round at this like in between also, so that I will also feel that people are listening and they have some, otherwise I will lose my interest also. So again, first of all, start with the questions. Why we need the valuation, like at this seed stage or pre-seed stage? Is it valuation is required, or we can postpone the valuation? Or if even if valuation is required, what are the methods we can do the valuation? Don't tell about the discount cash flow method, but any opinion what you can share with us? Anyone can raise the hand. Or
Yes, sir. Prabhu here. So, as per my understanding, the first thing, whenever the startup going for a fundraising, of course, we need to do the valuation in order to pledge the equity according to the rising fund. So, this is a necessary of valuation when we are looking for funding. And the second part, I think for valuation, as per even I was struggling to do the valuation of my startup. So I did some Google search. So I understood that there are around 4 to 5 method for the valuations in terms of let's say from the revenue side, multiplying 3 times. If it is tech company, 17 times. That's how the valuation going by in terms of the revenue. Other than revenue, I think there are 3, 4 more methods to do the valuation of the startup.
okay, thank you, Prabhu. Yeah, anyone else who can share something? Like, what is your, yeah, Ranjan, please.
Yeah, so I think the valuation is important because somebody is going to invest in your firm, and he must be knowing what is the value and what percentage getting for that amount of investment. First thing is that it is obvious that if the firm is already running and generating some kind of income, that is much easier for the valuation purpose. But I am curious to know that if somebody is just started pre-revenue stage, so in that particular way, how we are going to analyze that, what should be the valuation and how both the party can agree upon that. Because once the firm is generating, it is quite obvious that the calculation process, you can define that this is the valuation.
Yes, good. Okay, anybody else, or maybe anybody else who can want to share something, whatever he understand about this valuation?
Abhishek, question to the side.
Yeah,
So I
yeah.
agree. Yeah, I agree. Whatever the speakers have told about the need of funding, but need of valuation. But I feel that other than the revenue, the IP owned and the goodwill, all these factors also matters to decide the valuation.
Okay, so let's I will share something little bit. I just got this information right now. It just click on my mind. I will share an Excel, a blank Excel, where we will understand that the Ranjan question, what is that is very relevant. Ki, bhai, you have nothing, you do not have any traction, anything doesn't work, but now how you will value? So say suppose just one example. Okay, so well, one investor, VC, one came to you and he said, ki, say suppose valuation comes out to be, okay, just make it, okay, he's saying that the valuation is, your valuation is 2 crore, okay, and I will take say suppose your requirement is, say suppose 50 lakhs, okay, and he is saying that I will take 25% equity to give you this 50 lakhs, sorry, whatever. Okay, now he is saying that I will give you against 25% you can take 50 lakhs. So what you will say, like, will you agree with this deal? Like, just I came, like any VC came and he's saying, sir, your valuation comes out to rupees 2 crore. What I suggest, and we have a company also, we generally take 20 to 25% at a valuation of 2 crores for the early stage startups, and we generally take 25%. I will give you 50 lakhs. Would you be ready to give this two digit dilution, or will you be ready to give this 50 lakhs to me? So what do you will say?
So as a founder, obviously I would go for the lesser amount. Lesser means valuation can be good, but for the percentage should be then so that the valuation can increase. As a founder, that is obviously everybody is looking for. But how 2 crore is achieved is most important thing to know.
No. That's what I'm saying. What I'm trying to say is, I'm trying to give you a practical scenario. Okay. What I'm trying to say is, VC1 came to you and he's saying, sir, your valuation comes up because our portfolio companies where we are investing in and around 50 lakh rupees, and we give generally valuation of rupees 2 crore to a company, and we take 2 digits. So are you ready with that 25% dilution, 50 lakhs, and this 2 crore will be your valuation? No, I will tell you how that 2 crore will come. Like, but what I'm trying to say is the practical scenario is like this. We will give you the 2 crore valuation, and are you able to, dilute to 2 digit 25% against that 50 lakhs?
Initial phase, no, sir.
Yeah, Abhishek, it looks like it is a post-valuation deal. Generally, the entrepreneur go for the pre-valuation deal. So
Pre-revenue valuation.
No. Let's say suppose you are at a very, you did your MVP just now, and you have few beta customers, okay, 4-5 beta customers, or maybe you do not have the beta customers. Now the company, the VC comes and he is saying, he gives you the valuation of 2 crore. Whether you will go for it or not?
No, Abhishek, it's actually not good to go for above 10%. Max 15% as per my knowledge and understanding.
I think after MVP, if MVP is successful and we are going for beta customers, the debt can be a better option instead of giving 25% equity.
Okay. Now let's say suppose how this is, maybe I can say I will give. No, it depends upon it depends upon the founder. Maybe I will say I will give you because I need my 50 lakhs. I can make a product. I can do the MVP more. I can create beta customers. I can do at least I can generate 10 to 15 customers. So it's again upon the choice of the founder. It has nothing, like, maybe I will say that's like somebody say na ki 2 digit I will not share. Maybe if it is my company, then I will say no, I will not go for 2 digit.
Yes.
I will go only for up to 9%. Okay, I can only, this is my criteria. Now at this pre-seed stage level or seed stage level, what happen is valuation is, I will teach you how you can arrive at the valuation. Okay, what I'm trying to make a kind of base. So valuation is income approach. What Prabhu said, ki income pe approach rehti hai bhai. Earning capitalization approach is also one of the approach. Again, the comparable companies approach. Then at the same time, you have the discounted cash flow method. That is basically the wonderful method. Like most of the startups are doing the valuation according to this method only. Okay, so that is how you arrive the value of 2 crore. That is, but now the question is at the pre-seed stage level or seed stage level, the question is not on how you arrive at the valuation, but like somebody, each and every time whenever we meet with VCs, they are always saying that, sir, at this level, valuation is an art. how much the entrepreneur is willing to dilute, how much the VC is willing to invest in that particular startup. These all are very, very relevant. So what I will say is, say suppose how I will arrive at this valuation is, I'm just telling you the some little bit information, maybe that is also useful. Say suppose I will give you for team, then I will give you for potential market.
Sir, if I may add few points.
Mm-hmm.
This
Yeah,
is
please go ahead.
Nitya here.
Yeah, please
Yeah,
go ahead.
sir, I think the valuation may also depend on the product we are addressing, because there are certain products which gives us recurring incomes, and there are certain things which are a long-term products as well. Say if we are focusing mainly on agri machineries or like ours, which is into animal husbandry devices and machineries, the shelf life of those machineries are up to 5 or 7 years. So once we get a customer, that customer is closed for 7 years.
No, I
So
am
I
not
think so.
getting it. So what exactly you want कि किस पे depend रहेगी? What is the
मतलब
dependency?
किस टाइप का प्रोडक्ट है उस टाइप का भी, जैसे फॉर एग्जांपल इफ इट इज एन एफएमसीजी प्रोडक्ट, वो कंज्यूमेबल है जिसमें आपको रिकरिंग मिलता रहेगा, वंस इट्स कंज्यूम्ड इट्स डन. अब जैसे कोई भी आप ग्रोसरी आइटम्स ले लीजिए या एफएमसीजी ले लीजिए, वो
Understand.
डेली कंज्यूमेबल्स हैं. बट कुछ
So
कुछ मशीनरीज आती हैं जो काफी कॉस्टली भी रहती हैं, जो वन टाइम होता है, लाइक
understand.
लाइक टू फॉर 3 years और 5 years. तो अगर आपने एक कस्टमर पकड़ लिया, तो दैट कस्टमर इज क्लोज्ड फॉर 5 years एटलीस्ट.
Understand.
वहां पर कोई रिकरिंग ये नहीं आएगा कि वो दोबारा परचेस करेगा.
Understand. So maybe I will, Nitya, I will give your answer at the end. Maybe
Okay.
then you can get your answer at your own, or maybe I will give you the answer at the end, because I will not conclude here. Okay. So we will
Okay.
park your question right now, and we will answer it at the end. Now,
Okay.
say suppose you have a very good team, and that team has already, previously also they have closed one startup. Like closed means, startup means they have diluted, and they have, they have wholly diluted from that startup. The startup is now with the VC or another, or they already done the IPO, or maybe at a different level. But you exit from that. Your team has exited, and that same team is now associated with you. So what do you think? How much value? Maybe I will give you 1 crore. No, I'm giving you a different picture. I'm not telling you how the valuation is done. Valuation is not done like that. But this is also one of the way we the VCs or maybe people do this kind of valuation. Now what I will see ki, now you have a very potential market. So out of 1 crore, I have given this what I will, no, this is what I did is, this is 1 crore. 1 crore, I have given this 1 crore for each and everything. Okay, I will value accordingly. For team, I given 100%. The 100% allocation I give for this team. Okay, 100% allocation. Then potential market. Ki bhaiya, you have a very good potential market. Maybe you are an FMCG where each and every company is trying to say that we are good. So, but I will say ki nahi, your potential market is very competitive. So let's say suppose I will give you 50 lakhs. Say suppose you did your MVP with a very good sample size, and your market and feedback received from the customers or from the prospective customers are very good. So say suppose I will give you another, I will but again taking into consideration the market which has a little bit less potential as compared to the global market. So let's say suppose it is again my choice. So what I did is I will give you 60 lakhs. And for traction, as you do not have any much traction associated with you, so I will give you, say suppose 30 lakhs. Now say suppose for 4 crore is my 4 crore is my kitty. Out of 4 crore, I will tell you कि भाई I will invest 2.4 crore. 2.4 crore भाई मैं invest करूंगा आपकी कंपनी में से out of that 4 crore. or maybe again, now the question is again कि क्या किस परसेंटेज पे करूंगा, तो say suppose I will say कि sir I will the percentage will be again 25%. 25% I will take, 2.4 crore is a valuation, so say suppose 2.4 crore का 25% हो गया, sorry, into 25%. So 60 lakhs I will give you against a valuation of 2.4 crore. So as you know, Ranjan said, as many of you are at this stage only. So getting the values, I am telling you that this is also one of the way where how you can do the valuation, how you can arrive some of the figures of the valuation. I am not saying that this is the way, the valuer will make your valuation. This is only the way I can also do one of the measure where I can also see that this is I can give some kind of 1 crore or this kind of values to the particular figure to the of the amount, and I can arrive at this figure also. Or straight way I can also say ki no sir, I have only kitty of 2 crore, I can give maximum valuation of 2 crore and 25% I will take it and 50 lakh I will give you. Now you will say कि sir इसमें valuation कैसे हुआ, ना तो इसमें we have not taken discounted cash flow method, we have not taken comparable price method, we have not taken income earning capitalization method. So this is how they will arrive at this kind of valuation. So as I told you that those are just the ways to arrive at the valuation. So say suppose agar if kisi VC at this stage of point have taken is not able to give you the valuation of more than 2 crore, then even if you calculate your value as per, so say suppose you calculate your value as per DCF method and it comes out to be 5 crores. ठीक है, ये 5 crore आ गई आपकी valuation. Okay. Now say suppose calculation नहीं, okay, sorry. Now what he will say कि into, now he will say, now what you are looking is this is says about startup. Now the startup is saying, now it's a perfect example. Startup is saying as per the DCA discounted cash flow method, my valuation comes out to rupees 5 crore, and now as per the 25% I can take, because my requirement for say suppose I want a runway of around 2 years or maybe 18 months runway is the minimum runway. Okay, so I'm looking for 2 years runway. So now I want 1.25 crore for 2 years, which I will take in tranches or maybe straight way, and then I will dilute 25%. But now the VC is saying, no, I will give you only 2 crore valuation, 25% or 50 lakhs. Now what you will say? Is there any standard answer to it? Like any standard answer? As your valuation comes out after you discuss with your advisor or valuer, it comes out to rupees 5 crore. Now the VC is looking for 2 crore, or maximum he will give you 25%, or he will take 25%, give you 50 lakhs, and your demand is 1.25 crore. What you will do?
It's depending upon my requirement of the fund, because no general straightway answer to this question. It's totally depending on my situation.
Now say suppose another thing, another eye opener for you. Now say suppose as you ask the investor, sir, how you have arrived this kind of 2 crore,
Yes.
because all startup has already valued by this much, this one valuer at rupees 1.25 5 crore. How you came to know about this 2 crore? Okay. Now say suppose after taking every information from you, the valuer also came with the with this discounted cash flow method. Okay, now the valuer also come with the discounted cash flow method, because you ask very good question from the valuer ki sir, without discounted cash flow method I will not dilute. Okay, so you do one thing, you go first, I have already completed my valuation, you go and try to value my company. Okay, so now the VC now you have again, you said VC1 is not agreed to it, but VC2 came into the picture. He said I will go for DCF method, sir, But as per my DCF method and my valuer 1, here it comes valuer 2. Okay, now he gained to valuer, and the valuer said ki sir, okay na, as per the DCF method his value is coming around 3 crore. Okay, so what you can do at the best is you can give 75 lakhs against 25% equity. What you will say? Any observation? Two valuers, one valuer is giving 3 crore valuation, another valuer is giving 5 crore valuation. What you will say? Or is it possible? Guys, there are, there is no number cut. Like, you can answer anything.
So the process need to be redefined, and process has to be defined with the valuer 1 and valuer 2. Because the same cash flow method, how somebody is arriving at 5 crore and somebody is arriving at 3 crore. So obviously there is some mismatch in between.
Okay, so it means so when like when is valuer is asked to do the valuation, okay, he has his own like at the end of this session when we study the valuation report of, say, suppose Zomato, then you will understand what I'm trying to say. So but at this I will conclude. So what I'm saying is each and every valuer has a different assumptions. When he is giving the assumptions, he has a different assumptions, different tables, different kind of market assessment ki bhai kya market potential hai ki nahi. He has a different things to do with it. Nobody can give logically everybody should give the same picture. Everybody should give the same picture at the same time. If it was valued, then at the same time both the valuers should give the same picture of 5 crore ideally. But to the very extent, valuers may have a different approach to do it. So sometimes it may happen ki valuation amount may differ for different valuers. So it may happen, it can happen. So it's not like that it's only it will not happen because I am doing the valuation, I have another assumptions at my mind. It's not only the discounted cash flow method ki sir ye discounted cash flow statement to same hi aa rahi hai, then how your valuation is different, my valuation is different, maybe my calculations are very different. So there are the significant factors which will these which are to be arrived when we are arriving at the valuation. Those are to be discussed. Like I will tell you like how differently my valuation will come at 3 crore or 5 crore. But now the picture is very clear. As per the valuer 1 or valuer 2, or maybe as per the VC2, and as per the calculations we made, we can easily say suppose between 3 to 5 crore or valuation comes at around between 3 to 5 crore. मतलब मेरा valuation 3 to 5 crore के बीच में आ जाएगा. Now another point which came here is when VC and when VCs came here and VC asked, say suppose valuation is supposed to be done, then they don't go for valuation. They will not say that we first you do the valuation, then only I will give some kind of figure to you. Okay. उसका भी एग्जांपल मैं आपको एंड में जोमेटो की रिपोर्ट से दिखाऊंगा. आई विल टेल यू कि how valuation can be differ and why they have less reliance on the valuation. Like valuation is a method, but they don't prefer कि भैया valuation करके लाओ. If you give me the valuation report and take the amount. At the pre-seed or seed stage level, their approach is very different. They go for team, they go for potential market, they understand whether the startup has the capability or not, whether the startup has done the MVP or not, what is the product, whether the product is a failure product or whether the product has a very good market across globe. So those kind of factors needs to understand. So rather than just no, putting the valuation report and in front of a VC and saying, sir, we are looking for this much of fund, is not the right way to do at this stage of point, at this level. So my whole objective is to make you understand that at this level, it is not like that you prepare a kind of valuation report and then ask and then go to a VC or a incubator to ask for the that, sir, this is the funds I'm looking for. So it is only the calculation from both the ends, from both the sides. We have to understand lot of things. Then only we can arrive at the kind of amount which we are looking for. Okay. Now let's comes to the valuation part. Okay. I hope my screen is audible. The screen is visible to all of you. Vishnu, please confirm my screen.
It's visible,
Thank
yes.
you. Thank you. So just going for a little bit of theory and then we will go for a practical example, and maybe we will do some kind of exercise also. Maybe we'll try to figure out some kind of valuation of one of the startup from between you. So now what an investor wants. So each and everybody is looking for the future. Ki bhaiya, future of the company should be very bright. It has lot of market potential, and significant opportunities there, growth opportunity. Market size is too big that they can even export the product outside India, and even they can easily market the product in India. They have a wonderful technology which can be used to market the product. It should not be like that a product should not be, it should be a product. It is a kind of technology that is he is using, which can easily be addressable at all at a globe. So you don't need to spend a lot when you are going from one territory to another territory, or at the same time from one country to another country. So the technology part of that technology part is basically each and every VC is looking for. Then solid market, product, solid team. At the same time, after high returns, each and every investor is looking for the higher return, because so this is the basically your like, if you are also an founders or also an equity investor, you also put your equity, put your everything in this. So what is your expectations are also here only. You are also looking for higher return. You are also looking for everything, every market, good market opportunity, business plan. Now this is the very important questions. Like each and every time whenever this question comes, I think this should be answered very, very carefully, and this answer is also required by or RK Raftar committee also. That what kind of funding, how much like what basically, where you will use this kind of funding. Like examples we have already discussed, the milestones where you will use, and where you will use the funding, like in payment of salaries, in payment of giving it to providing the market, capital expenditure, or say suppose working capital, where you will be using the funds, and where you will be, and what you will be trying to achieve with the help of those milestones. You are trying to achieve is, say suppose you are trying to achieve a traction of, say suppose 1 crore within 3 months or 6 months. Then you are trying to achieve you are trying to export your product also. That is also one of the milestone where you will say ki, we will be exporting this product in next month, or maybe in the next milestone is export of the product or services. So you are supposed to identify the milestones also. You are supposed to identify. So maybe what my milestone is to get a first 100 customers, onboard first 100 customers in the by within 6 months with the help of these funds. So this question and answer should be this should be very important. And again, we will not need additional funding for at least, say suppose my runway. So this is basically the runway. So basically I told you that generally in startup industry 18 to 24 months runway is basically required. So you identify your runway amount, ki this is my runway which I am looking for. I will achieve this much of funds, it should be required. I will achieve these milestones, and I will not need funds for, say suppose 18 or 24 months, and this much of fund is required. So the best way to do the valuation at this stage is how much fund is required by you. So say suppose you are looking for 2 crore fund for this next to 24 to next 2 years, and this is how the with the back calculation, you can arrive at the the valuation. But again, once it comes to the calculation will be followed only with the help of those methods which I told you, which we will discussing it further. Now how valuation differs, so each and like as I told you, like early stage pe to bhai ideation MVP hai ki nahi, traction kuch you have achieved some traction or not, or maybe once it was a once you have the you cross the seed round, or you cross the series A round, series B round, then it comes to the how much commercially, what are your commercials, how your growth scale up, how whether your product is internationalized, has international presence, how much is your mature, and like whether the product, services, everything, or the entity is matured or not. So maybe after 4 or 5 years, when you established a your turnovers are stable, your working capital is stable, your each and everything is stable, like your company becomes stable, then then the valuation of the company is more or less dependent on the discounted cash flow method or other methods. In that way they will be calculating the things, and in that way they will try to figure out the value of the company. But in the very initial stage it is not possible, because though you all things are hypothetical, are all things are just a forecast. So based on the forecast they are just taking the information. Now a type of investors, so as investor type is basically bootstrap. So bootstrap may the criteria is basically the sales, because even if you are not able to make the sales, you like how you will be able to sustain your company. For government, when the government is giving fund, they're always looking for jobs and taxes. When family, friends, and F&F is giving you the fund, they are looking for ROI, which is more than the bank. That is again the repayment. They will also see whether you are able to make the repayment or not, and they will be giving you the market rate. When angels came, they always look for 20% plus return. Angels I'm talking about. Maybe VCs also a little bit. VCs generally look for the series A, series B. They're always look for the IPO. Yeah, when they will exit the company, what will be the valuation and how much they will be getting the profits. Then strategic, innovation, defensive revenue, that is okay. Now considerations in financial strategy. Then I think after this we will see how the valuation is done. So basically these are the when you are going for the financing of the startup, these are some of the questions which you are supposed to answer, and which the VC will look into it to get the kind of valuation, or to give some kind of value to the company. So what stage is your company, person and company assets do you have, company performed to date, like have you made any kind of sales, have you done the MVP, how many beta customers do you have, how large is your market size is large or not, because market size, so this market size is very 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 important for each and every VC who will invest in the market. How attractive is the industry to the investors, like whether the lot of investments have already involved in that particular sector. Like agri sector right now is very now people are looking for agri sector, they're looking for good startups, so that investors are looking to invest in agri fintech startups, good agri fintech startups. So what is the reputation of your management team and advisors, how fast you can grow with the of money, whether you have a technology that can help you to grow faster, like the technology is very 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 important, which will help you grow faster. What is your perceived return, what is your perceived risk, say suppose risk versus return, say suppose this much of risk is involved in that company, it means we are looking for the beta, like whether the company is risky, or whether the risky versus risk versus return, like if it is more risky, then investors are looking more return, if it is less risky, then investors are looking for lesser returns. Do you have the trademark, process equipment, patents, so that you can protect your company, or you protect your product from the others. Stakeholder, promoter is willing to give up, now another question is key. That's what I told you na, stake promoter is willing to give up. So say suppose I am saying that I will not dilute my shares for single digit, I will go for only for single digit. So there is no particular yes or no answer ki say suppose ki as I told you na, maybe for any startup 25% dilution at 50 lakh he is okay for that, because he is looking for another angle. Maybe 10% is 10% of the dilution. People are not confident, or people are not happy with, willing to dilute more than 9, more than a single digit. They are not feeling willing to dilute. They have a different reasons to do it. If sir mera zyada ho jayega, then like when I go for series A, series B round, I have only very less left with me. So there are different reasons to there is no standard call. But yes, the standard call is for a very early investor. People should think of diluting from 10 to 15%. So basically it is the standard. It is the standard. Maybe people will ask for 20-25%, or but yes, the standard is between 10 to 15%. It is okay. And again, the amount. Again, there is no standard ki kitna valuation hoga. Maybe people arrive at the valuation on the basis of the, say suppose you have a 1 lakh sales right now. So people will make you, okay, I will give you on the basis of the sales only. I will give you the valuation. I will give this sales into 100 times. I will make a sales that you are able to make the sales 100 times. So I will give you valuation of 1 crore. So people can arrive the valuation at any at any amount. No, these are the valuation methods. So generally, of course, cost asset approach method, market approach method, where we will see the comparable companies, and income approach method. So in general, cost approach, let's discuss all the methods. So in the cost asset approach method, we will generally it is not the good way. It is not the it is one of the way to arrive at the valuation, but generally it was not taken into consideration by the valuers, because book value, it generally takes the book value, replacement value, liquidation value of the balance sheet values of the assets and liabilities, and generally do the valuation accordingly. So generally this was not preferred by the valuers. Another method which was again generally not, but yes, if I can see the valuation of recently valuation of HDFC Bank and HDFC, so I can see that this is also one of the one of the method which was used for arriving at the values. So in that amalgamation method, that market approach was used. It's not, DCF was not used for coming out the shareholding ratio of the company. So we will discuss that HDFC Bank valuation report also, don't worry. So this method is generally because it is very hard to find the comparable companies. That's why that's why valuer is not able to find the comparable companies for a startup, because startups always go for innovation, different innovations. They have a again that there are less standard parameters against per multiple of revenues, PAT, book values. Again, they have a different revenue per user, net margin per user. So that's why valuer don't use largely. But yes, if there are comparable companies for the startup, if you know some comparable companies for the startup, you can think of doing the valuation according to this method also. Valuer can do the valuation, because in that case one of the entities already is listed in the market. So we have the figures and we have all the information. We can discount, or we can premium your information. We can make the discount accordingly, and we can arrive at the equity share value of the company. So this method is preferable but very less used. Now the income earning approach, this method has two methods to do the valuation. First is the earnings capitalization method, or profit earning capacity value method. This earning capitalization method is also less used as compared to the discounted cash flow method. So more or less in general, largely all the valuers are using discounted cash flow method to arrive at the valuation. Now we will not, so we will go directly to the discounted cash flow method. We will not see a lot about earning capitalization method, even though I have taken the example also. I have taken an example of how you can calculate the value with the help of earning capitalization method. But again, we will discuss largely in detail about the discounted cash flow method, and what, how that the Ranjan is saying ki the valuation is coming at 3 crore, and at the same time another valuation is coming at 5 crore. So what kind of changes are can be done so that to arrive at the different values. So first is earning capitalization method. So in this method, if you can see these examples, ki bhai, year one, this is the, you know, the perfect example of a startup. If you can see that units sold, say year one 44 hai, fir 40 hai, fir 250 hai. This is how, you know, the startup revenues are, you know, increased. This is how, so we can see the total revenues here, we can see the operating profit here, we can see the earning before interest, depreciation and amortization. So we can see the EBITDA also here. So in the first 2 years, it's a loss, and in the another 3 years, it's a profit. So these are the financial projections. So based on these financial projections, assumptions of financial earning potential will be arrived as a value driver. So now let's comes to the another, let's comes to like this example. So basically what we are trying to do here is key, say suppose we look for the future earnings, that what will be our future earnings that we have made already, we have made the projections. Then we will arrive at it at what is the industry comparable P ratio. Like anybody who can tell me what is P ratio?
Profit to earning ratio.
So say suppose my no, not profit to earning. Sorry, not profit to earning. Any other guess or any other? What is P ratio?
How much margin we are having? Basically, margin. You should tell about the margins.
Equity, sir.
You can even Google it. Okay, so let me try. So price earning ratio means price divided by earnings. So say suppose my price is, say suppose 100 rupees, and my price, like say suppose for a listed company I'm talking about, or maybe for a not listed also. So say suppose Zomato has a price earning ratio of, say, so I don't know what is the price earning ratio of the Zomato, but say suppose we take an example कि Zomato का जो price है वो around 200 के आसपास चल रहा है. So that becomes the price. So P becomes the price, that is the listed company price, which is coming, which is it's automatically coming from the Nifty, and divided by earning means the earning per share, how much earning. So I don't know whether they are still in earning. So I think they are now in the profit. So say suppose their earnings is, say suppose 1 or 2 rupees, or maybe less than 10 rupees. So my price divided by earnings. So this is the PE ratio of comparable companies. So in that case of the Zomato, 200 divided by 10, 20 is the PE ratio. Like, you know, 200 is the price and earning is the 10 rupees 10 per equity share. So that is the P ratio of the company. Higher is the P ratio of the company, like the companies which have a very, very higher P ratios, you know, in general, like, you know, their price is going up and up. You know, their price is very going up and their earnings are a little bit less. So in general, what we will say कि यार अगर उसका किसी का P ratio बहुत ज़्यादा है, तो maybe I will not invest in that company. That is again subjectivity. Why my question is why you will not invest in that company? So I will say कि sir, because their earnings are very less and their price is going much higher and higher. Sometimes if the price crash is there, even though they are not, you know, their earnings are not even matching with their price. So my point may be कि भैया नहीं करेंगे. Another point may be कि if a price is going very up as compared to the earning, so maybe somebody will say ki, okay, invest in this company. So as a conservative approach, I will not invest. As a going forward approach, I will invest. So price earning ratio of those companies we need to see, and the discounted estimate by required. So what is basically my required rate of return? If I'm looking for a required rate of return, so say suppose as an equity shareholder, I'm looking for a 50% return per year from a company, or maybe I'm looking for a 40% return from a company. So that we need to consider. This is how the simplest method to do the valuation in this case. So say suppose if we take an example, 1 million capital is required, 2 million current revenue, an annual growth we have taken it considered as 50% कि भैया 50% से वो annually उसका जो growth rate है 50% रहेगा भी. से सपोज इफ अगर 1 लाख प्रॉफिट है उसका इस साल, तो उसका जो नेक्स्ट प्रॉफिट जो एनुअल ग्रोथ रहेगी वो 1,50,000 होगी. आफ्टर टैक्स प्रॉफिट मार्जिन वी हैव कंसीडर्ड इट 10%. इंडस्ट्री कंपेरेबल पी रेशियो वी हैव टेकन 15, एंड होल्डिंग पीरियड वी हैव टेकन इट 5 years, and required rate of टेकन वी हैव टेकन at 50%. Little bit complicated at this point of time. So but as I told you, we will just only see a little bit calculation and we'll go directly to the DCF because that is more relevant for you. So here what we did is we did the compounded revenue of 2 million. We'd arrive at the 15.8 million as on date after multiplying with the 50% return factor of 7.593. Then we arrived at around 1.51 million, that is the after tax margin. By multiplying after tax margin with the P ratio, we came out 22.65 is the future value of the company after 5 years. When we discount this 22.65 future value to till date, we come around at the value of 2.98 million, which is giving the ownership required rate of return of 33.5. So basically we will not invest in that company because the return of the invest required by the company is 50% and the amount of ownership required by the investor is 33.5%. So basic rule, thumb rule here is the higher the investor's required rate of return, the lower is the company valuation and higher the investor's equity stake. So the most significant learning is forget about example, forget about the method. Higher is the investor's required rate of return, lower is the company valuation. So if your required rate of return is higher, it means the valuation of the company comes out to be lower. That is the basic small rule. Now let's not take this example. Let's come to the discounted cash flow method. We need to understand this method, and that is basically the object of my session, is to make you understand this method and how we can arrive at this kind of values. Now discounted cash flow method, but what basically is can you somebody explain it? What is discounted cash flow method? Kya matlab kya hai iska? What is the meaning? Anybody? With just this the line discounted cash flow, you can easily calculate that what we are trying to say. People are there, or I lost the audience?
No, we are here.
So whatever the cash flow we are going to generate over a period of time, say for the 5 years, we take a rate of interest and discount a particular rate of interest and discount that cash flow for that present value.
Okay.
So that we can get the exact value as there.
Great. So in a very simple sense, if I will say ki I have calculated the cash flow statement, as many of you have taken ki bhaiya mera prepare the, I have shared you one cash flow statement in the last session. You told us ki please share the cash flow statement, where we draw its very simple information. These are my inflows, these are my outflows. This is how we prepare the cash flow statement. Okay, inflows minus outflows. Now those inflows minus outflows we have calculated for next 5 years. Now we discount those inflows and cash flows, we discount the net cash inflow. Now why we are discount that net cash inflow? Because the future value of the company, say suppose after 1 year you are earning 100 rupees. What is the current value? What is the now as on date value? Is it 100 rupees or it is lesser than that?
Lesser than that.
Why it is lesser than that?
Because the rate of interest, suppose if I'm going to deposit the same amount in a bank, I'm going to get an interest on that. So
thank you.
I'm depositing 100 rupees present, and most probably I'll be getting 108 rupees after a year. So
okay.
Present value will be 8%, 100 rupees.
Thank you, Ranjan. Thank you. So good explanation Ranjan has already given. So once the question is the value of the company. Say suppose the 100 is the value of the company, or the value of the amount which we receive after 1 year, say suppose 100 rupees. The 100 rupees is not the right now value. The right now value is, say suppose 91 or 92, because 91 or 92 rupees, say suppose I deposit in the bank, I will get, say suppose 10% return, I will get 100. So as of now value is always less. So we need to discount as to arrive the value as on date, today's date, we have to discount those cash flow, those 5 years cash flows. So that's why we have to discount it. So that's why the name is discounted cash flow method. Ki bhaiya, whatever the cash flows you arrive at 4 or 5 years, you discount those cash flows in order to arrive at the value as on date. Okay. Now basically 4 to 5 years, 3 to 5 years, I will always say 5 years, not 3 years. 5 years you have the projections for 5 years. you are supposed to calculate the terminal value business growth for after 5 years. Ki bhaiya, after 5 years, what will be the business growth? So in general, the business growth for a company after 5 years is in general 5% to 5%, not more than 5%, or maybe maximum 7%. We will not say ki after 5 years or company will grow, at a 200% or 300%, because it will go for a terminal, it will go for infinity. So till infinity, we have to calculate ki your business or company will only go up to 7% returns, because in that case also we have the returns will be stabilized, the sales will be stabilized. Now forget about the explanation. Let's come directly to the to the picture. Now, to arrive at this, value, let's come to this example. Now, this is the perfect example for all of you. Ki bhai, now profit before tax, कि आपका जो भी profit before tax होगा, then उसमें depreciation we will add, because depreciation has no cash outflow, so we arrive at the total cash inflows. Even if you don't want to arrive at this profit before tax, you can simply write down ki what basically is your cash inflows of that cash inflows for all 5 years. Okay, if you don't go for the profit before tax, you don't have the profit to till 2 years, write down the loss here, write down the total inflows, what is your cash inflows for 5 years. Write down your cash outflows, say suppose in terms of capital expenditure or whatever it is, write down the cash flows, net cash outflows for these 5 years. Taking the provision of tax provision of 25%, we have already arrived at the free cash flows to the equity. So what we did is the cash inflows minus outflows, we arrive at the cash flow to the equity. So in the first year, we have a negative cash inflow, 73,70,000. In the second year, we have a 23,75,000 positive cash inflow. In the third year, year 4, year 5, this is how we have calculated our cash inflows and outflows. Okay, the net cash inflows. Now, the question came, ki, sir, we have already considered, we have already arrived out the figure of net cash inflows and outflows. Now, what we are supposed to do? Now let's come to this picture. Now what we are supposed to do, I am saying the discount rate is 50% here. If you can see my discount rate, I have taken the discount rate of 50%. Now you will say that how you have taken the discount rate so big, that 50% is very, very big. So no, every valuer has an answer to it, ki bhaiya, why we have considered 50% as a discount rate. Now we will calculate how we arrive at this 50%. So free cash inflow you can easily arrive out. Now let's go to the 50%, how you have arrived at the discount of 50%. Now here we will see that how we have arrived at the 50% discount rate. So say suppose risk-free rate of return, there are standard formula to arrive at this figure, so don't think you are supposed to make a very complicated situation. Just arrive at the free cash outflows, cash inflows minus outflows. And now let's come to the discounting, like the, try to take out the discounted discount rate. So discount rate, these are 6 things which we are supposed to write down here. So if we will say like risk-free rate of return, we have considered risk-free rate of return of 10%, which we what basically base we have taken is the 10-year bond yield. If you can Google 10-year bond yield, whatever the 10-year bond yield is coming, 8.2, 8.4, 7.5, you considered it as a risk-free rate of return, because if you invest in that company, because that is the minimum rate of return you are getting when you are investing in a risk-free assets. Like if you are investing in a FD, if you are investing in a bond which will give you the fixed returns, the fixed return is 8%. Okay, Google it, you can get the value. Now expected market return, this is also, you Google it, Nifty 50 index. If you just write down the Nifty 50 index of last 10 years, average, weighted average it or average it, you can arrive at the figure that how much is the market risk return you are getting. So maybe I have taken it as 11%, or maybe it will go up between 11 to 12 or 13%. Now the another thing is beta. Now beta is basically very, very important, but beta values can also be arrived. Beta value, if you can, Google the beta value, you can arrive some kind of, case studies where you can see the beta values. If you have some companies which already done the valuation, you can also, or already listed in the listed companies are there, where your startup is also there, you can see the beta values of those companies. So here we need to study little bit more, लिटिल बिट, ये आपको थोड़ा सा स्टडी करके देखना पड़ेगा कि भैया बीटा वैल्यू क्या आ रही है मेरी कंपेरेबल कंपनीज का. सो से सपोज इन दिस केस व्हाट आई विल से कि so in general, what is beta is the risk. In general, if it is 1, then there is no risk, it is neutral. If it is less than 1, it means 0.80, 0.90, it means the company is not risky. Even it has no neutral, it is very less risky if the value is less than 1. If value is more than 1, it means the company is risky. Okay. In general, at the startup phase, people are considering beta value of around 1 to 1.8. In between 1 to 1.8, you can consider your beta value also. Hypothetically, you consider it as 1.5. Okay, a little bit more risky for from the point of view of the investor. Okay. Now let's comes to the another very most important part where the people give you the business risk premium. Now what is basically the business risk premium? Now it has, it is again, beta is a little bit subjective. Business risk premium is also a little bit subjective. Here we have taken taken lot of consideration, lot of assumptions when we arrive at this kind of value. So basically, if the business risk premium is higher, it means you have a low marketability of the business. It means the market of the business is very low. Okay, so based on the very specific characteristics of the company, so say suppose like we have a geographical scope, we have a very less geographical scope, we have a very less customer concentration, we have a very less depth of management, then again we have a very less financial strength as of now. What we can say, maybe the perceived risk of achieving the projections ki bhaiya you can't able to make this, you have made the projection but you are not able to achieve those projections. Company other specific risk jo ki involved rehti hai company mein. So these are the some of the positive or negative adjustments which where you are supposed to do this kind of adjustment to arrive at the business risk premium. So say suppose I perceive the business risk premium of 37.5%. But as Ranjan, maybe the another value here considered the business risk premium of say suppose 25% also. So if the business risk premium, if the beta value is little bit different for each and every valuer, then it means the valuation amount will also differ. So the formula now let's come to the formula how you can arrive at the cost of equity and the discount factor. So cost of equity, it has a very standard formula, it's the business risk premium, that is 12.5 plus beta, beta is 1.5. Then again market risk rate of return minus risk free of return, that is 11.8, that is 3%. If you calculate all these figures, it comes out to be 12.5%. So cost of equity means cost which the equity people, the return which equity holders are looking is 12.5%. But after considering the business risk premium, we have added 37.5%. So it comes out to be 50%. So 50% annual return is the VC is looking for in this case. So this is how we have calculated. Okay. बहुत ज़्यादा calculation नहीं है. Even if you can take a photo of this, even this slide, you can easily calculate your business risk premium also a little bit of, and then you can do the sensitivity analysis कि अगर मैं business risk premium 37.5 रखता हूं तो मेरी valuation क्या आती है, 25 रखता हूं तो क्या आती है, 12.5 रखता हूं तो क्या आती है. Again you can do your sensitivity analysis here. Now this is a 50% discount rate. So you discount this with the discount rate of 50% and you can arrive at these values. So the value will arrive as around 2.69. So 2,69,680 is the today's value after 5 years. So this is the value we have arrived as on date, as on today after 5 years. Now the next calculation is the computation of perpetuity value. Now this is also another calculation. So first is free cash inflows. Another thing is how to arrive at the discount rate. And the third and the last thing is how to arrive at the terminal value of the company. Means after 5 years till infinity, what will be my terminal value? So this is the way you can arrive at this terminal value. So say suppose in this case, after 5 years, if you can see the example, 15 crore 15 lakh is the 1 minute. 15 crore 15 lakh is my cash inflow after 5 years. You can see this 15 lakh 15,000 from this slide. I just copied this slide at profit before depreciation and tax after 5 years is 15 lakh 15,000. I just add 5%. That 5% I will be getting till infinity. 5% I will be getting. I just add this 5% for terminal value of 6 year ki bhaiya 5 after 5 years se mujhe perpetuity तक 5% की growth मिलती रहेगी. I arrived the value at around 50 lakh 90,000 75,000. I deduct 25% tax and I arrived the cash inflow for terminal 6 value 11 lakh 93,000. This is very simple calculation. Now, how you arrive at this 27 crore 83 lakh is it is simple. If you can Google the how you arrive at the perpetuity value, you can arrive at this formula. So formula is whatever is the terminal value of 6 year into 1 plus growth rate 1 plus 0.05 divided by your market risk premium minus growth rate. So 0.50 minus 0.05. So this is a simple mathematic calculation. This is a simple formula which you can Google it also, and you can arrive at the terminal value for 6 years. You can discount this terminal value. The terminal value discount factor is 1.31. You can discount it and you can arrive at 3.64 value, 3.64 crore. Now this is after this the valuation, you have arrived the valuation, it means. So 2.69 crore after 5 years till perpetuity 3.64 crore. I just total this 6.33 crore, that is the enterprise value. What is the number of equity shares as on date? I just divide it by 10,000 and I just value arrived for my equity share is 6337. So valuation comes out to be 6.33 crore and valuation per share comes out to be 6337. So this is how you can arrive at this valuation. Okay, I will give you the table also, you know, the Excel value of the table where you can put and, you know, comes out to be the you can derive your values. Okay, I will not ask questions because many have questions or maybe people are not able to understand it. So again, if you want me to explain a little bit again, I can explain, but 3 things are very important: the free cash inflows, free cash outflows, how you arrive at the discount factor, and another thing is how you arrive at the perpetuity value, which is the terminal value. So any question on that, or maybe we will, you know, we'll go further.
Abhishek, what is the meaning of perpetuity value?
Perpetuity value means the value which was, you know, which you will be getting after 5 years, not from 6th year to the infinity, till your business, you know, will go further. Till infinity, what will be your value? So till infinity, we have taken the value of 3.64 crore.
Okay,
So basically, this is standard formula which is to be considered to arrive at the present value of perpetuity.
So if this the enterprise value that has come 6.33 crore. So it means it is the whole life value.
Yeah. This is the as on date, the full value of the company.
As on date.
Because we have already discounted it. Now these are the discounted factors.
Good.
You can see the discount factors 0.31. These are the discount factor 666, 50% discount factor. So this is the value as on date, the whole value, enterprise value.
Okay, understood.
Considering that it will go to infinity, it has no problem with the going concern. It will go to, like, you know, to infinity. It will the enterprise will run. It will not close after 10 years or 15 years. Considering those are the assumptions, we have considered the value of 6.33 crore here.
Yeah, understood. Okay, fine. Thank you.
Okay,
Sir, in this one, the discount rate we have calculated is 50%. Out of this 50%, 7.5% is something that is assumed by the investor. 12 point, yeah, in this one, if you see that 37.5% is the risk of the premium or business risk, what the investor is assuming. And that's what you
This investor will not assume. See, this valuation is not done by the investor. Valuation is done by the valuer. So valuation is done by the valuer. So it will be assumed by the valuer only on the basis of the situation, on the basis of the discussions made with you, on the basis of the many risk factors taking into consideration. Like as I told you, like you can see, say suppose, like what is your geographical scope of the company, what is your customer concentration, आपकी टीम कैसी है, डेप्थ मैनेजमेंट कैसा है, देन व्हाट इज योर फाइनेंशियल स्ट्रेंथ, एट द सेम टाइम व्हाट इज योर perceived risk of projections, have you made kind of projections which looks very बहुत ही ज्यादा लग रहे हैं, मतलब बहुत अपर साइड के प्रोजेक्शंस लग रहे हैं.
इसको काउंटर कैसे करें? Because somebody is assuming it 3 crore, somebody is assuming it the 5 crore the valuation. So obviously this is the amount that the depending upon the perception of the valuer, जो भी वो analyze कर रहा है, इसको हम काउंटर कैसे करेंगे सर?
So what happens is, like whenever we are doing the valuation, whenever you discuss the valuation report, whenever the valuer is also discussing many things with you, so इसमें क्या होता है कि you are supposed to satisfy the valuer. So you have lot of counters you can show, like initial stage पे business risk premium high lena, it is generally usual. It is usual to whatever the calculations I am showing here to you here na, we have calculated this kind of figures and for one of the agri startup. So ये ऐसा नहीं है कि hypothetical example लिया है, because I cannot show the startup valuation report here, that's why I just put the valuation here only. So no, what I'm trying to say is not कि the valuation is real, the price is also real, but again I cannot tell you what is the for which company I have did the valuation. So what I'm trying to say is the initial level पे जो ये business risk premium होता है ना, we are generally taking it higher. Now you are supposed to help us कि भैया इसको lower कैसे लिया जाए. That's why you told me ना कि now how I can reduce it. So you can show me you can show me that आपके जो projections हैं, you can show me that the projections are whatever the projections you are taking so are real. Now how you can show that the projections are real, it means whether it means you have the past experience कि भैया ये मेरा सर past है, so taking I am considering कि मेरी जो sales है वो से suppose 10 lakh है इस year में, तो next year मेरी से suppose 25 lakh जाती है, where I will be going to different geographical regions. This is the technology which helps me to go for different geographical regions. This is my this is one minute. This is my growth rate. This is the in general growth rate for the you can see in this industry. So lot of factors which can help you to prove that you have your business risk premium is not high. People generally take in one of the case we have considered business risk premium of only 10%. So it is not like that कि हमने business risk premium ज़्यादा लिया है कम लिया है. What we generally do is like how valuer do the things is कि whenever we find that the projections are not up to the mark or projections बहुत ज़्यादा satisfying नहीं लग रहे हैं, we are not able to people are not able to digest it, but again we are taking it because the projections are again projections. Forecast होता है ना, like it is nowhere written that forecast becomes the reality. Okay, I will show you one example also where the forecast is not the reality. Like in no case forecast becomes a reality in general. So in that case, business risk premium थोड़ा ज़्यादा लिया जाता है. The competitive market competition is very high. So lot of Google information, lot of other information, lot of comparable companies information, फिर कुछ arrive होती है आती है ये business risk premium. So for you, whenever you are doing the valuation, you have to understand and you have to ask your valuer कि business risk premium कितना लिया है, beta value कितनी ली है. So basically this is also that's why you ask ना, I told you कि भाई now you can understand कि when you do for valuation कि where I should put my head on it rather than just totally dependent upon the valuer.
Yes sir.
Okay.
Thanks.
Okay, now this is basically you can see this slide is ki bhaiya, how you can arrive the value. So for a valuation, if you ask me, sir, do my valuation, like if you ask a valuer that please do my valuation, sir, do this kind of valuation, do this kind of valuation, he will only go with DCF or income or whatever the methods we have discussed, earning capitalization method or market method or cost method. But as I told you in the very early Excel, I told you कि भाई in general at the very pre seed stage or seed stage में जो valuation होता है वो discounted cash flow method से बाद में निकालते हैं. First we will take out the valuation on the basis of the whatever is the requirement of the company, and on the basis of whatever the amount I can give you to the company at a particular dilution rate. So it is basically at this stage of point, there is no science involved in it. There is no mathematics involved in it. Okay. So if you say कि sir ये mathematics निकाल के अभी निकाल देते हैं, then we will go for with this particular values to the VC, and they have to invest it because this is the real values and I will achieve these values. So it will in general not happen. It will in general not happen like that. It will go like as I told you, multiples of. So there are different valuation methods which are not used. These are not used, but this is how people generally prepare a range of valuations. So say suppose one person go with the valuation, he take out the valuation according to the DCF method also, and then he take out the valuation according to this other valuation methods also, like multiple of revenues, EBITDA, user base, these kind of methods also he is using. So what I'm trying to say is that you should prepare a data of these also, this data also, where you can have, or when you come to the table, once you go to the table with a VC, you can have these figures also, because this is how I have arrived at this value. So say suppose if you are saying that my valuation is 5 crore, so either you arrive the value of 5 crore by DCF method, either you arrive the value of 5 crore after considering the comparable company, that this is the comparable company whose value is something like this. Now considering a discount on this company 10%, 20%, I arrive the value of this. Maybe you will say कि मेरा तो revenue का 100% कर लिया मैंने, that my revenue is 1 lakh, I considered it into 100, so 100 times of my revenue I consider it as a valuation, as a value of my company. Say suppose I have a user base of say suppose 1 lakh, I say कि sir मेरा user base I multiply it with again 100, I will say कि my value I have arrived at. So you have more or less different things to do in different methods to arrive at this kind of value. So multiple of revenue, multiple of EBITDA, user base, multiple of industry specific value data. Say suppose your GMV, as everybody knows GMV. So they suppose you are at a loss, but you have a GMV of say suppose 10 crore. So you think कि GMV का 10 times कर लेता हूँ, तो 20 crore GMV का 10 times कर लेता हूँ. So say suppose 10 crores ना, तो 1 अरब मतलब 100 crores is your value. So this is how discounted cash flow method, as I told you, is also one of the way to arrive at the value. What I'm trying to tell you here is कि you should do your lot of exercise in a different way to arrive at the valuation amount. This is what I'm trying to say, considering the statutory accounting, tax implications, whatever it is. Now valuation range. Say suppose I told you that value range between 7 to 5% of company equity for 25. Say suppose I told you now, one of the investor will say, sir, I will take 7.5 to 10% of the company equity for 25 lakh investment. So they have the basically in many incubators, accelerator programs, or maybe for VCs, they have a pre-decided equity percentage. तो उस केस में आप क्या करोगे? If you have a pre-decided equity percentage, what you will say? You will go for it only. Then you have a 25% discount to valuation for the next round by the investor. They are considering it कि भैया पहले आपने इन्वेस्टर ने इतना करा, मैं अभी डिस्काउंट ही दूंगा आपको, क्योंकि आपकी कंपनी, your company is not moving ahead according to the what you perceive would have. So there are different methods to arrive at the value of the, but but if you need a valuation report will be as per the either from the DCF, more or less from the DCF only. Okay. Criteria of valuation at idea or early stage, limited data, more subjectivity. I told you na कि team, potential market, competitive scenario, फिर customer traction कितना है, timeline, business pipeline कितना है, how much business you have in your hand, how much letter of LOIs you have, your past record for conversion, like you have 100 LOIs, your past conversion is only 50%. So what is your business or financial model? What is basically your like how you are doing the business. So these are many factors which are totally important once you are doing the valuation. Process of valuation, as I told you, that more than one model should be used. Identify current models relevant to the venture, rational use, long term, not short haul, risk assigned, probability. You do the sensitivity analysis also to arrive at the value. Identify deal issues for negotiation, practice before negotiation. That is okay. So this is basically the summary which I am I am trying to trying to put into before you. So in summary, look at the different valuation models to arrive at the valuation range. Discounted cash flow will be one of the method. Build a financial model which will capture elements of business model, like how to address the deal rational. Try to prepare yourself for the negotiation. I'm not considering in this session negotiation as a another subject. Another 1.5 hours is required to make you understand what is basically negotiation. Then another, identify the deal issues. Ki by deal issue matlab, once you are disclose, once you are discussing the information, discussing with VC, you are supposed to identify ki by how I will go with the VC, what I should say in front of the VC, what I should avoid like when I'm doing the negotiation with the VC, what will be the methods which I should say, and what will be how they have arrived at the valuation. Is it pre-capitalization he is trying to say, or is it is post? If he is saying I will invest 50 lakh at a capitalization of valuation of 2 crore, it means the valuation he is giving at the pre-valuation stage or post-valuation stage. That is also should be very clear at this point of time. So it is only practice which a person should do. If lot of practices is required once you arrive at the deal and once you negotiate a deal with a VC. Okay. Now, apart from this valuation, there are a lot of other things also which you are supposed to understand, that there are your financial due diligence will be also one of the way, like for your financial due diligence, legal due diligence, operational due diligence. These are 3-4 due diligence which are before a VC invest in your company. He will check these kind of things also. So rather than arriving at the value, these 3-4 things, these due diligence is also forms part of your wherever you failed in these due diligences, the VC will not invest in your company. Whether you are paying taxes regularly, whether you are not, whether your books or accounts are properly managed, whether your operations are properly with a proper SOPs that you are running the operation. So these are the very important things which also have an impact on the ultimately the companies to get the money from the VC. Once a VC invest, he will look those kind of things as well. So this is all from my side. Where we before we discussing any other valuation report, like any questions you have. Now answering to the Nitya's question, where she asked that we sold to product to one of the startup and another company, and then we blocked for 7 years or whatever years. So the answer is it has no meaning. Once we calculate the valuation, as I told there are different methods of valuation, and the most prominent method is discounted cash flow method. So under discounted cash flow method, we are arriving the values after cash flows. We are arriving the cash inflows or outflows. So just like like many machineries were sold, many equipments were sold which have a life of 2 years, 4 years, 5 years. So we are not worrying with those kind of, okay, whether the life of the product is 4 years or 2 years or 1 year or 6 months, or whether the repetitive customer will be there or not. We are looking for the inflows. If you have the good inflows in hand, if you have a good market where you can see your product will be sold, your sales will be high in in the coming years where the projections were made. So if these things are there, then it has no meaning with the so the question is like it has no relevance in it.
Okay.
Until unless you have a good inflows, outflows, good risk, less risk, the product is less risky, the market potential is there, you have a high chance of getting a good valuation.
Okay. Okay, sir.
Okay. Now, yeah, any other questions? Hopefully not. So let's come to discuss one of the again. So let's discuss the the Zomato valuation report. So 2-3 valuation reports are available in the Google. So I can only discuss those valuation reports, and I will share those valuation reports also. Other than that, I can't discuss because it is not available. But what you can do with the valuation report is like you can if you know any company who did the valuation, like who is a competitor company of your competitor company, and you did the valuation, that they have already completed the valuation and they have arrived, they have already taken series A round, series B round, या कुछ ऐसा भी ले लिया है. In that case, what you can do is you can take out the data, master data of that particular company, from the MCA website, and by downloading that master data, there is a a PAS phase 3 form. So in that, if the most of the valuation reports are available in that master data also, because once they did the valuation, only after the valuation only they are able to calculate or give the equity shares to the company. So in that case, you can have access to the valuation reports of those companies. So at least you can think कि क्या उन्होंने कैसे value करा था, what basically not many information is publicly available, but yes, whatever the we will discuss the Zomato report also. This is a kind of report you will be getting of those comparable companies also. So in that case, you can do accordingly your exercise. So I have, let me share it. So yes, this is the Zomato valuation report. Okay. So Zomato did his valuation report. This is 12th November 2019. I will not go in detail because my like almost 11:30 is already there. But you can stop me anywhere wherever you find कि I need to discuss it. Okay. So this is basically the valuation report of the company कि भैया ये recommendation fair value निकालनी है company की. We have to calculate the fair value. 12th November को they have get the engagement letter from the company. This is basically the content, the introduction, background of company, valuation methodology, discounted cash flow method, income approach, they have considered it, conclusion, DCF analysis, assumptions, and capitalization table. Okay. Now this is basically कि भाई fair value is the निकालेंगे. This is my I've been assigned to appoint a date of appointment, valuation of date of valuation, fair market value से करना है. Going concern is also one of the assumption that company is a going concern. Whatever the information they have taken from the company, like annual reports of the previous years, provisional financial statements, projected financial statements of next 4 years, next 5 years, company profile, other relevant information. Now, this is the company background about the company, that what basically Zomato is, then where basically the global reach of the Zomato, like where basically the Zomato is working. Now this is the valuation methodology. They put the methodology of discounted cash flow method. So they have written the discounted cash flow method under income approach. Discounted cash flow method is they are considering it. Market approach, they are not considering it. Okay. And then they are saying what is the basically the firm's cost of capital, how they have arrived at the cost of equity. This is the basic simple information which we have also arrived. That is the only way to arrive at it. How they have arrived at the terminal value, considering how much is the growth rate they are considering it to arrive at the terminal value. I will show you how they have arrived the values. And this is the per equity share they have arrived. So this is 1,51,657 is the per equity share of the company, which is they are saying. It means just 2 years before the company got listed, they have the proposed equity share value of 1,51,657. Okay. So per share value is 1,51,657, which the valuer is saying. These are the assumptions which they have considered while arriving at these values. I will share these reports with you also. You can go through these reports. And if you have any questions, now this is the discounted cash flow analysis. You can see here the growth rate, the revenues they are considering. Now, if you can, now the question is 2024, they have a revenue, they are forecasting a revenue of 2,13,249 millions. And if you can see if you can Google it, what will be their revenue as on 31st March 2024. Luckily, we have that close the 31st March also. So you can see they have taken the forecast of 2,13,249 and they have achieved only, I think, 25% or maybe less than 25%. So their as on date, their maybe 30%. So as on date, their revenue is only 63 lakh something, 63,000 something only. So now what you will say? Now, sir, they are saying that they will be having projections of 2,13,249 millions. Now they have only achieved 30% of it. So basically, those are the projections of 2019. Na? So they are projecting according to the situation. More achievement is little bit every time little bit different only. Now this is the EBITDA, then they are adding amortization or depreciation, then this is the percentage of revenue they are considering, this is the EBIT, then tax payable they are considering 25.2%, that is marginally it's good. Then they are saying that these are in the first 3 years we are at the loss, in the only fourth or fifth year we are at the profit, we have a positive cash inflows. Accordingly, there is they have added increase in working capital. Then the future cash flow, so first 2 years future cash flow is negative, the next 3 years future cash flow is positive, net future cash flows. Now this is 22.5% is the market, is the discount rate they have considered. I will show you how they have calculated. So 22.5% is the discount rate they have calculated. They have discounted this their cash flows with 22.5%, and they have arrived at this present value of future cash flows. So that is 93,683. And after adding this 93,683, the amount of terminal value comes out to be 2,06,068. And now present value of terminal value comes out to be 93,000. So 93,000 plus 9,546, it comes out to be 1,874, and dividing it to the number of equity shares, their one equity share value comes out to be 1,51,657. That is the value of one equity share. Now these are the some of the how they have taken out the beta. For calculating the beta, they have considered these 4 companies as their considering the assumptions of these 4 companies. Then they have calculated the unlevered beta. Unlevered beta means you have only equity in the balance sheet. Levered beta means you have debt also in the balance sheet. So the debt should be that considering debt also in the balance sheet, the levered beta is calculated. Then the equity risk premium is 10.4%, which is basically the Nifty 50 index. Then the risk-free rate is the 6.91%. That is the 10-year government bond yield. And company specific risk premium, they have considered 3% only. So for this valuer, as Ranjan is asking that how much is the risk premium. So here the company specific risk premium is only 3%. Now the concluded cost of equity comes out to be 20.257%, and now they have considered 22.5% as the equity. Now this is the capitalization table. Forget about it. It has not so much relevant at this point of time to understand it. So this is how the valuation of this Zomato is considered. Now let's say suppose the valuation report of Byju's. It is also available. So Byju's valuation, like it's, as everybody knows, Byju's. So from the very up stage to the downfall. So on 6th February 2019, they have signed the valuation report. So here also, most of the information is basically same. So basically what we are trying to say is we are just trying to, you can have your questions. Like if you have any other question, we can discuss. So here you have taken the turnover, the projected turnover, then they are considering is the profit before tax, then the profit after tax, then their PAT margin, then the free cash flows, then discounted factors, again the present value of factor, then again adding the terminal value into it, and then arriving at the value of value per share arrive is 38,654 is the value of equity per share at in 2019, which they are considering on the basis of this report. Now, like these are the simple things कि भैया हमने कैसे लेकर आए. So risk free margin is considering 7.37%, market risk premium is 15.33%, equity they are considering 17.14%. Okay, and on the basis of the formula which we have already discussed, these are the things. And this is the valuation report. These are some of the assumptions which they have considered, valuer has considered while valuing this company. So this is how the valuation is considered. If we can see the the valuation report of the bank, SDFC Bank and SDFC Bank Limited. So SDFC Bank and SDFC Bank Limited, they have not valued as per the DCF method. Okay, first of all, they have not valued as per the DCF method. Their valuation is on the basis of the I think 1 minute. Let me check how they have. Okay, share exchange ratio they have considered on the basis of the 1 minute. Fair equity share propose amalgamation. So just in the morning only, I have just taken out this SDFC Bank Limited. This also I downloaded. So they have taken market valuation approach, where comparable companies के जो figures हो, जो values होती है, उनको arrive करके इन्होंने अपना exchange ratio निकाला है. Now I will tell you how they have arrived at this exchange ratio. Now SDFC Bank has 554 crore 55 crore number of shares. SDFC has around 181 crore shares outstanding. This is as per the outstanding which is in the Nifty. Then how they have arrived at the value is like as per the comparable transaction method के basis पे, comparable companies multiple method के basis पे उन्होंने they have arrived at the value, and this is how they have arrived at the value. Okay. Now how they have arrived at the value, like both companies wants to become a SDFC Bank Limited, na? Like SDFC is now merging with SDFC Bank Limited. So they have considered कि SDFC जो bank है, they have the market price, of 1462 share, they have the market price. Now they have considered the comparable company also, one or two comparable companies which has the market price of 1593. They have weighted that 50% weight they have given for 1462, their own market value. Another 50% was given to the another company, comparable company, and then the value of per share comes out to be 1527. For SDFC also, the SDFC current value at that time is 2410. They have taken the another comparable company also 2718. There both the companies have 50% shares, so the 50% weights. So their value comes out to rupees 2564. So now their share exchange ratio comes out, because now SDFC Bank Limited बनना है ना, SDFC has to merge with SDFC Bank Limited. So now the share exchange ratio comes out to be 42:25. It means 42 shares of SDFC Bank will be issued to the shareholders holding 25 number of shares. That is the share exchange ratio they have considered. So for every 25 shares held by the HDFC, like say suppose I am a shareholder of HDFC, so I will get 42 shares of HDFC Bank. That is the meaning with this is the ratio is giving. So this is how they have calculated their exchange ratio on the basis of the comparable market price method. So 42 is to 25 is the ratio between HDFC Bank and HDFC. So this is also one of the report you can study for your reference. Okay. Any other questions? I hope कि अगर 10 if you get even the 10% or 20% out of it also of my session, you will definitely have a little bit learning.
Sir, do you have any templates for calculating using MPV method?
I will share it. The Excel I will
Okay.
share. Maybe it will take
Thank
a
you.
little bit time, but I will definitely answer it.
Thank you, sir.
Okay, if there are no, so thank you everyone. If there are any other queries, you can have a WhatsApp. You know my number. You can WhatsApp, and I can try to help you to solve that query. So by the time, thank you everyone. Have a nice day. Bye.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Thank you, Abhishek. Thanks a lot.